You're listening to the Saskatchewan Real Estate Podcast, where we chat with real estate experts from across the province to learn what's happening in the real estate market. Here's your host, Ron Caroni.
Welcome to another edition of the Saskatchewan Real Estate Podcast. I'm your host, Ron Caroni, and this week we are very happy to welcome Chris Kolinski of Chris K Mortgages to the show. Chris has been in the Saskatoon mortgage market for 8 years. He has a wealth of knowledge, and we're very happy to be sharing it with everyone today. Welcome, Chris, to the program.
Thanks for having me, Ron.
How are you doing? Tell us a little bit about yourself and why you're here.
Yeah, so I guess you hit the nail on the head. I've been in it now for 8 years. I've been doing mortgages for. So I started as a mortgage broker in February of 2013. So I guess it'll be 8 years in February. And I also host a podcast called I Love Mortgage Brokering, and another podcast coming up shortly. And so I've been in the business for quite a while, and I know now, I don't know how far you've gone along telling people where you come into play in all this, but you are officially part of the team and a mortgage associate yourself. So.
Yeah, I'm definitely very excited to be entering into the market, and that's why today's topic works so well, because we are talking about the 5 things that all mortgage professionals want you to know. And as in you, I think you're meaning clients out there who are looking to buy property, whether they're refinancing, whether they're getting into that first home. And so we're going to go through 5 things today that people should know. So we're starting off with number 1, pre-approval versus pre-qualification. And there is a difference. One almost never happens.
Exactly. So I think that the word pre-approval gets thrown around a lot. I think it's kind of the standard term that people are referring to when it means that someone's looking at their mortgage and just saying, yes, you can get a mortgage, and no, you can't. But historically, pre-approvals meant a little bit different, or it used to mean something a little bit different. And essentially what that meant was, back in the day, I don't know how long ago, but a lot of lenders were, they'd look at everything. They look at income, down payment. They look at everything except the property, and they'd say, you are pre-approved. You can go buy a house. You're good to go for a mortgage amount of X amount of dollars, which just meant that they're approved for that 300,000. Let's say what that number was. But times have changed a lot, and most lenders aren't going that route anymore. Most lenders aren't saying you're pre-approved for X amount, which means you're guaranteed this money if you buy a house. There's a lot of things that come into play when you're looking at buying a home and that approval. Specifically, they look at your income, they look at credit, they look at your down payment, and they also look at the home, the home that you're actually purchasing. That actually matters a lot when it comes to being approved for a mortgage. So a lot of lenders have moved from the pre-approval and move more towards a pre-qualification. What that means is they have someone that does mortgages all the time, every single day. And they look at your income, they look at the down payment, they look at your credit, they look at everything except the house, the specific property that you're looking at buying. And they say, based on these things, you are pre-qualified to buy a house. You have a really good shot of getting approved for this mortgage. So there's definitely a difference when it comes. A lot of people, what I've seen is that when they think they're pre-approved, they think that they can go ahead and make an offer on a place without any conditions on it, which just means they're locked in and they're committing to buying that place. And the risk with that is if you're not fully approved on a mortgage, or if you don't have the cash to buy that place outright, you're on the hook if you can't get a mortgage. And typically you're putting a deposit of anywhere from $5,000 to, I've seen upwards of $20,000 on a deposit. So it really puts you at risk if you're removing those conditions early. So there is a difference between pre-approval, pre-qualification. Typically, if you're being pre-approved, it really means you're just being pre-qualified. The mortgage professional that you're dealing with is looking at the situation, looking at all your documents and saying, yes, you can go ahead and make an offer on a place. And the other thing I wanted to clarify was being pre-qualified, a mortgage professional can pre-qualify you, not good. I guess what I'm trying to say is there's some mortgage professionals out there pre-qualify better than other mortgage professionals. Let's just say some will just look, they'll take an application, they might pull credit, and they're like, yeah, things are good, just based on the stuff that you're saying. But a good mortgage professional is going to gather all those documents up front. They're going to look at your income documents. They're going to look at your down payment documents. They're going to look at everything that they know is going to come up with that deal upfront during that pre-qualification stage to make sure that things are really lined up so that you can end up going and making an offer on that place.
That great first step to just kind of give people an idea of maybe the price range they should be looking for, or if there's anything they need to clean up on their application beforehand.
Exactly. And I think a lot of people would be surprised that, maybe they had a parking ticket on their credit bureau. They might have really good credit, but there's a parking ticket on their credit bureau that they didn't even know about. And I've seen that lots where, it's been like 3 years and there's this parking ticket that's been sitting there and they had no clue it was there. So starting that process early and getting that pre-qualification right off the bat really helps you dig in and find to see if there is anything that comes up during that process to fix, and gives you enough time to do that.
And just before we moved on, you touched on something called options. Can you just quickly explain that for someone who has no idea of what options are?
The options as in for like in a mortgage or?
Exactly. When you're writing an offer and you're going to, oh, pardon me, I said options,
Conditions.
conditions. Yes.
Yes.
Could you please explain conditions?
Absolutely. So when you're making an offer on a property, you're going to add in some conditions on there. And the conditions, so an offer is pretty much just like a promise note that's saying, I promise to buy this off you um, at this price on this date. And then there's also going to be some conditions on there that have to be met in order for this contract or this promise note to be in full force. So some common conditions would be like a conditional based on a home inspection, that it passes a home inspection to the buyer's requirements. Another condition would be conditional on getting a mortgage approval before X date, or maybe conditions on there. Maybe there's some stuff that were like a hand railing that was broken. You might say, look, I want a condition is that we'll buy this as long as this is fixed before X date, or that kind of stuff. So the purpose of putting conditions on there is, one, it gives you a safe out so that if you can't for some reason get a mortgage approval, you now can get your deposit back and just walk away and really no skin off your back. But it also gives you a chance to put in your due diligence in the meantime before you really commit to buying something. Because at the end of the day, like, this is going to be one of the largest financial decisions of your entire life, is buying a house. So you want to make sure you're doing that due diligence throughout that process.
Fantastic. All right. So moving on to number 2, minimum down payments. Most people think 5% down is only available for first-time home buyers, and this isn't the case.
Yeah, so this is one of the biggest common misconceptions of the mortgage and home buying industry is people think that the only time that you could put 5% of the purchase price for a down payment is if you're a first-time home buyer, but that's simply not true. It doesn't matter if you're buying your first house or your 10th house, as long as you're planning on living in this home, you can put 5% of the purchase price down. You'd be surprised on how many people think that just because they own a house right now and they're planning on selling it or even keeping it as a rental and buying a new place to live in, that a lot of people think that they need 20% to buy that second house, which is not the case. In fact, most of the mortgages that I personally do are going to be in that 5% range. Maybe there's first time home buyers in there, but there's also people that are currently living in, let's say, a condo, and maybe they've had 2 kids since they bought and now they need to upgrade to a house. That next house that they're buying is going to be 5% down. So that's something that not a lot of people know. Really, like, the nice thing about putting 20% down is that you can avoid paying CMHC premiums. That's kind of the nickname for them, but it's called mortgage insurance. And so by putting 20% down, you can avoid paying those costs. But let's be real, most people don't have that 20% for a down payment. So being able to put down 5% is crucial.
Excellent. Okay, so number 3 is in quotation marks here. So do you want the best rate or do you want to save the most money? So these things are they're rarely the same thing.
Yeah. Yeah, I think, in today's day and age, Facebook, if you're looking at buying a house and you're on social media, Facebook knows you're buying a house. Instagram knows you're buying a house. Google knows you're buying a house. And so what they do is that they start showing you ads with these extremely low rock bottom interest rates. And, the media will do it too. You'll see it in the news when a lender drops their rate below a threshold and the media latches on because it's the first time it's ever happened. But what they're not explaining is that there's a lot of conditions that are going to be on a mortgage like this, and they're typically called no frills mortgages. That's what we call them in the industry. And they usually have like extremely high buyout penalties. They have sales only clauses, which I've actually seen some people be burned on that. And that's typically where, like, if you wanted to, let's just say if rates dropped lower and you wanted to refinance to take advantage of those low rates, or if you needed to pull equity out of your house, a sales only clause prevents you from doing that. The only way that you could break your mortgage is by selling to someone that is not related to you. So there's a lot of these like stipulations that are on these extremely low rate mortgages that end up costing the client a lot more money down the road. So I always tell people, like, do you want to save, or do you want the best rate, or do you want to save the most money? Because typically people are coming to me and they're like, I want the best rate. I want the best rate. But they don't sit down and, take a look and say, hey, how much am I actually saving taking this low rate? Or should I take a little bit higher rate and save money elsewhere? And what's going to be better? So that's one of the positive things with using a mortgage broker, is because we do that for you. You don't have to sift through all the products and rates with every lender that's out there, because we do that for you. So that's the thing I always say. Do you want the best rate, or do you want to save the most money? Those two things aren't always synonymous. Sometimes they are, though. Sometimes you'll get in a situation where the best rate will save you the most money, and that's kind of that perfect world. But in reality, that doesn't happen very often.
Fantastic. And quickly running back to something you said, buyout penalties, something that might be a little misunderstood by a lot of, common folk, but it's a really important thing to keep in mind as you're going through the mortgage process.
It's absolutely crucial, because at the end of the day, it's about, on average, people break their mortgage 3 years into their term, whether that's needing to refinance, getting a better rate, or they need to sell their house and buy a new place and upgrade. That's typically happening around that 3-year mark. And you want to be in a situation where, you're not getting hammered with $20,000 in buyout penalties.
Right. To your point, I think a stat from 2016 was that 6 out of 10 Canadians at the 38-month mark will break their mortgage.
Yep.
So something to keep
That's
in
a
mind.
huge stat. That's a big stat. And that means, like, and most people don't think, like, almost every single person that comes in my office says, and I ask them, how long are you planning on staying here? Almost every single person says, oh, at least 5 years. And then 3 years down the road, they're coming back and be like, we need to upgrade. I've got a couple like that right now, where I helped them 5 years ago, or 3 years ago, 4 years ago, and now they need to upgrade. So
Fantastic. Hitting on number 4, qualifying. It is not what you think you can afford, but what the government of Canada thinks you can afford.
Absolutely. So, what your personal finances are. How much you can afford. I mean, you're the one that's sitting there and running through your monthly finances. So when you're thinking like, hey, I know I can afford a $400,000 house because I know I can afford that $1,800 a month payment, it doesn't necessarily mean that the government of Canada is going to agree with that. So the GOC has put into a lot of rules in place to help prevent people from over purchasing and taking out larger mortgages than what they could potentially afford down the road. So they've implemented things like the stress test is a big one. So in October of 2016, they implemented a stress test, which means we as mortgage professionals, the banks too, everyone has to stress test you or make sure you qualify at a higher rate. Right now, that rate is 4.79%. They want to make sure that you can afford, if rates were to go up in 5 years from now to 4.79%, that you can still afford that mortgage. Now, to put that in perspective, rates right now are 1.79%. So that's 3%. The government of Canada wants to make sure that you can afford a mortgage if rates were to jump by 3%. Is that likely? I mean, in the next 5 years, I would say probably not. But that's what they think you can afford. So just because you think you can qualify for something doesn't mean the government of Canada is going to agree with that, which is why it's super important to get pre-qualified, because you don't want to have to go out and, you think you can afford 400,000 and now you're going out with a realtor and looking at $400,000 homes. And then you go to get a mortgage approval and they're like, actually, you can only afford 350,000. Now there's two things that happen with this scenario. Is that one, you've just wasted all your time. You've wasted your time. You've wasted the realtor's time. You've wasted the seller's time of all these houses that you went to look at, that $400,000 price range, houses that you can't afford based on what the government of Canada says. But the other thing is that you're going to be disappointed looking at $350,000 houses now, because you just went and looked at that creme de la creme that you want at 450 or 400,000. And now you're taking that price reduction. You're not going to get the features that you were just getting so pumped up about going and looking at, right? So it's extremely important. Get pre-qualified just so you know what you can qualify for.
Excellent. Number 5, and last but not least, the mortgage process. So your first steps and how to be prepared. Something that maybe someone who, just like you say, I know that I can afford that $400,000 house, but then you actually go and sit down with someone and like you might be out of your depth a little.
Yeah. So I think regardless on what stage you're at in the process, I think or in your personal process, I guess, the first thing that I always tell people do is talk to a mortgage professional. Get pre-qualified as soon as possible. Because like we said earlier, if there's anything in that pre-qualification that, is limiting you from buying what you need to be at, this gives us enough time to fix that, whether it's credit, whether you need more down payment, whether you need to work more overtime hours for the next year. This gives us enough time to help you get to that point of home ownership. So the first step in this whole thing is getting pre-qualified. Even if you don't, because a lot of people think that they can't buy a house, even though they have the saved up down payment, they have a good job, maybe they missed some payments on their credit card 2 years ago and the bank told them no. And, but now they're in a situation where they're their credit's improved. Those missed payments have been pushed in the past. You haven't made any missed payments since. A lot of people think that they can't buy when in reality they can, right? So you'll just never, ever know until you start that first step and get pre-qualified. That's the first thing. And then the next thing I would say is get all your documents in order. As I mentioned before, there's a few things that every single lender, bank, doesn't matter where you go for a mortgage, you're going to need. They're going to need your income. They need to know how much you make. They're going to need to know how much you have for a down payment, and they're going to need to know your credit. And then they're going to put all those 3 things together and give you, and it'll spit out a number based on what, again, the government of Canada says that you can afford. So get that stuff in order. Talk to your manager, get a job letter, grab your last 2 years taxes, T4s. If you're self-employed, make sure you're getting your last 2 years notice of assessments and your T1 general. So it breaks down where your income's coming from and how much write-offs you have, that kind of stuff. Print out a 90-day history of your down payment. Take that even further. If you're not quite ready to buy right now and you just have your money sitting in like a checking account, take all that money out, put it into a savings account and leave it in there for as long as possible. The cleaner you have your down payment on, what I mean by clean is as little transfers in and out of that bank account, the easier it is to get approved for a mortgage, because we have to track all that stuff. So that's what I would recommend for getting the docs ready. Income docs, down payment docs, and then you can even pull your own credit at equifax.ca just to see where you're sitting.
Fantastic. Chris, we have hit the 5. So number 1, pre-approval versus pre-qualification. Number 2, minimum down payments. Number 3, do you want the best rate or do you want to save the most money? Number 4, qualifying. And lastly, number 5, the mortgage process. Anything else to add for what people should know about the mortgage process or mortgage brokers in general?
Yeah, I think the thing that I really want to hit on the head is by using someone like myself or Ron, you're really getting the best of all worlds. We work with 20 plus different lenders out there. Our services are free to you. It costs you nothing to come in and get an opinion from us. And we do this every day. This is our jobs, right? And we know what every lender's offering, and we know where you're going to sit best. I mean, we'll ask you the right questions to figure out where, your needs in a mortgage are, and we'll place you where we think is the best place for you. So, yeah.
Great stuff. Chris, thank you very much for sharing all of your knowledge and information. It was fantastic sitting down with you here. Before we let you go, can we get some of your contact information, phone number, social pipes?
Yeah, for sure. So you can just find me online. Like I do everything online. So you can go at chriskmortgages.ca. You can find me on social media. So it's the facebook.com/Chris Kolinski Mortgages. And then on Instagram is at Chris Kolinski. And everything I do is on social and online. So you can find me there.
Thanks again, Chris. Really appreciate it.
Thanks, Ron.
This has been the Saskatchewan Real Estate Podcast. If you like this episode, find more information and episodes on our Facebook and YouTube pages. If you'd like to be a guest or have a conversation you'd like to learn more about, let us know by messaging the show on Facebook. Thanks for listening.